All right, diving in today. We're going deep on, well, I guess you could call him an investing legend, Philip Fisher. Specifically, his book, Common Stocks and Uncommon Profits,
Yeah.
like the whole approach behind it. And, we designed this one just for you, the learner. You're the one who wants to learn things fast, get to the good stuff without all the fluff. you know?
Yeah, exactly. So Fisher's book, it's a big one, influential. And we've got some background on Fisher himself, too, like how he thought about investing. We'll be digging into his famous 15 points, which help you evaluate companies. Then there's this idea of scuttlebutt that's all about gathering information. And of course, we got to talk about when to buy, when to sell, the whole philosophy behind his long-term success.
Right. So it's about giving you, the learner, those tools, those actionable strategies to find those maybe like exceptional investments. We'll break down why doing your own research, like really digging deep, is so important. And of course, that long-term mindset, all that good stuff, but we'll keep it fun, no jargon overload here.
Let's jump right in. The core of Fisher's strategy, it's built on these 15 points and this thing he called scuttlebutt. Fisher was convinced that if you're really good at picking the right stock, selling, it kind of becomes less of a big deal. You can hold on to those good companies for a long time. And this idea, it comes straight from his dad, actually. He has his own 15 points for checking out businesses.
15 points sounds pretty important. What are they, like, in a nutshell? I'm getting this sense that they're a way to, like, see how strong a company is, if it's going to do great in the long run, or maybe hit some roadblocks.
Exactly. Think of it like figuring out where a company fits in the whole world of business. Are they going to be successful, or are things going to go downhill? Now, you mentioned before that trying to use these in college didn't quite click right away.
Right.
Right. And that's where Fisher would say the craft is in the scuttlebutt. And getting good at that craft is like anything else. It takes time. You got to put in the work, try things out. The 15 points, those are the what to look for. Scuttlebutt is how you find it.
Okay, scuttlebutt. It's got a catchy ring to it. I know it's not just, like, random gossip, though. Fisher had a deeper meaning in mind, right? So how do you describe it? And why do you think it was so crucial for, being a good investor?
So scuttlebutt for Fisher, it meant you got to go beyond what everyone on Wall Street's saying. You got to find real-world info to understand a company, the good and the bad. Think of it like doing your own homework, but on Main Street, not Wall Street. Talking to customers, see how happy they are. Talking to competitors, see where the company stands. Talking to suppliers, even ex-employees, get that inside scoop. You want info straight from the people who actually deal with the business, not some biased report or rumors. And the key here isn't just talking to anyone, it's finding the right people and then asking really good follow-up questions, getting to stuff that's not obvious.
So it's like getting that raw, unfiltered view from all sides. And Fisher thought this worked for any type of investment.
Totally. He was adamant about that. Scuttlebutt, those 15 points, they weren't just for one kind of stock. They work for value stocks, growth stocks, big companies, small companies. A great example is Nucor Steel back in '76. He saw it as a really promising investment. Small steel company, low cost, great management, and they had this innovative tech that made production cheaper. Plus, they were strong in their niche. What's really interesting is that Fisher, who saw himself as a value investor, he bought Nucor. And his dad, more of a growth investor, he bought it too, both using the same 15 points. They saw the strength of the business. Fisher later sold, made a good profit, but his father, he held on for decades. Nucor became the second biggest steel company in the U.S. That shows you how powerful these principles are.
Yeah, that Nucor story, it really shows you how these principles can find good investments no matter your style. Now, I remember reading that the Scuttlebutt chapter, even though it's short, Fisher thought it was one of the most important parts of the book. Why do you put so much weight on it?
He saw scuttlebutt as the action part of the 15 points. The 15 points tell you what's important in good investment, but scuttlebutt is how you actually go out and find that information, confirm if a company really has those qualities. His son explained it later, said the father basically skipped over the how-to part in the book, maybe thought readers would just know how to do it. But the real deal, like his son wrote in his book, Super Stocks, is to focus your scuttlebutt on 3 groups: customers, competitors, and suppliers. They're the ones who know the company best.
So it's not just asking the same old questions, right? His son talked about the art of it.
Exactly. It's all about those follow-up questions. It's like being a composer, you get an answer, and then you got to come up with the next question that's going to reveal even more. It's back and forth, a real investigation. Fisher's father, he was known for being amazing at asking those smart follow-up questions.
Makes me think of a question Fisher heard later on from James Michaels. He asked, What are you doing that your competitors aren't doing yet? That little word yet, it seems like a big deal.
Oh yeah, it's really insightful. You ask most companies what makes them different, and they'll talk about small improvements, nothing groundbreaking. That yet makes you think about real innovation, a real edge that no one else has. And those are rare.
Even when things were tough, like in the 2002 bear market, what was Fisher's dad's take on things?
His belief in capitalism, in the Western economy, it never wavered. He always said that companies that were well managed, the ones following those 15 points, avoiding all the hype and fads, they'd survive, even thrive when the market's down. So it's all about those solid fundamentals, not the short-term ups and downs.
So focusing on what really matters, not the market noise. Okay, let's talk about the man behind these ideas, Philip Fisher. What's his story? What shaped his thinking?
Well, Fisher's roots in San Francisco, they run deep. His family, on his dad's side, they were Jewish, came from Prague in Germany, arrived in San Francisco back in the 1850s. It was a time when the city was booming. And get this, his grandfather, Philip Isaac Fisher, he was a big part of a truly American story.
Okay, I'm intrigued. What'd he do?
He was Levi Strauss's first accountant, and he managed Levi's first store for his whole career. Talk about an early connection to American business.
Wow, that's a cool link to a real icon.
Yeah.
What about Fisher's immediate family, though? How'd they influence him?
So his dad, Arthur Lawrence Fisher, became a top orthopedic surgeon, like a pioneer on the West Coast. And Philip A. Fisher was named after his grandfather, born in 1907. Family was a big deal in shaping him, especially his social skills and that curiosity he had. They had these weekly dinners at his Aunt Carrie and Uncle Henry's place. Imagine, like, lively debates on all sorts of topics. That definitely helped him learn to express himself, think critically.
Sounds like a great environment for learning. Where'd he go for school?
He went to UC Berkeley for a bit, then Stanford. He felt more at home at Stanford, seemed welcoming and, prestigious. His Aunt Carrie actually helped him out financially to study business at Stanford's grad school. Kept it a secret, though. She and his grandfather figured it was better for him to think the money came from his dad. Subtle, but supportive.
Interesting. So when did his investing career really take off? And when did Common Stocks and Uncommon Profit become like a must-read?
The late 50s and the 60s, those were Fisher's golden years. The book came out in 58, and boom, he's a national star in the investing world, like instantly.
Okay.
In San Francisco, everyone wanted his advice. It's amazing how fast that book took off, especially compared to, say, Benjamin Graham's Security Analysis, which took longer to get popular.
It wasn't just individual investors, right? Did it impact like the academic world too?
Totally. For a long time, Stanford's business school, their graduate investment course, it was taught by Fisher himself or by one of his trusted followers. Show you how important that book was, even in academia. And he kept giving lectures at Stanford, even when he was dealing with dementia later on, dedicated to teaching till the end.
Wow, that's dedication. How did his priorities change as he got older, more experienced?
As the 60s went on, he seemed less interested in the spotlight, He got more into deeply analyzing individual companies. People said he was incredible at judging CEOs and management teams. But funny thing is, he wasn't good at delegating, so his sons couldn't really get involved in his firm. Another thing, he rarely praised people directly, even his own son, not until later in life. He'd brag about his son to others, but not to him directly.
Interesting personality. So how did he find new investment ideas?
He had this unusual way. Any young investor who had a stock idea, they could pitch it to him. Just one meeting. If he liked their thinking, liked their logic, he'd keep talking to them, exchanging ideas. But even with all these pitches, he was super picky. Only once in his whole career did he invest in a stock based solely on someone else's recommendation. He stuck to those 15 points rigorously.
So he stayed true to his principles. Even with health issues, he seems like he was a fighter.
Yeah, he had this toughness about him. In '99, he got really sick, pneumonia. But he pulled through thanks to his strong will and his family who were there for him. It's a lot about his personal connections, too.
Definitely shows his strength and the strength of his relationships. Okay, let's dive into his investment ideas, the insights he shared in his book. He starts with a basic question. Why invest in stocks at all? What's the point?
Simple answer, straight from Fisher. To make money, to build wealth over time. He talked about how, in the old days, people made fortunes by riding the economic waves, buying low, selling high. But he saw an even bigger opportunity, long-term growth.
So he's saying long-term growth is the better, more rewarding way to build wealth.
Exactly.
Yes.
He pointed out that in the 25, 50 years before he wrote his book, there were tons of companies where, say, 10 grand could have turned into $250,000, or even way more, just by finding truly great businesses and holding on. Didn't need perfect timing, just the ability to spot those exceptional companies with lasting advantages. And he thought these opportunities would only increase, even get more common.
He also talked about how the business world was changing, right? What were some of those shifts and how'd they tie into his investing style?
Yeah, he noticed that more and more companies weren't just family-run anymore. You had professional CEOs and management teams. And he saw how crucial corporate research and engineering were becoming like vital for growth and staying ahead of the competition. He knew research was expensive and slow. Sometimes it takes 7, 11 years to really see the profits. But he said, you got to commercialize those discoveries. Do it right. Lots of research, sadly, doesn't even make money.
And what about the bigger economic picture, government involvement, inflation? How do you see those impacting investments?
After the Great Depression, in all those government programs starting in 32, Fisher saw a big shift. The goal was to prevent another huge crash. But he thought this would lead to, like, built-in inflation. And in that kind of world, long-term bonds, they become risky. Your money slowly loses value. So he concluded that stocks, if chosen carefully, were the better way to protect and grow your wealth when inflation's around.
This brings us back to his core idea, finding those outstanding investments, the ones that'll grow for years. He loved the scuttlebutt method. So how does scuttlebutt help you find those great companies?
Scuttlebutt, it's all about digging deep. Talk to people who actually know the company. Competitors, vendors, suppliers, customers, even research scientists, anyone who might know about the company's tech or future plans. It's about getting that first-hand info, not relying on rumors or hype. And remember, confidentiality is key. You got to keep things quiet to get honest answers.
Okay, let's unpack those 15 points one by one. The first one's about market potential. What was Fisher's thinking there?
The first point, it's all about finding companies that are selling products or services that have room to grow. The market has to be big enough and growing so they can increase sales for years to come. One-time profits, like from cutting costs, that's not as good as steadily increasing revenue. He used Alcoa, the aluminum company, as an example. They were lucky to be in a booming industry, and they knew how to make the most of it.
And point number 2 is about always innovating. Why'd Fisher think that was so important for long-term success?
He believed that companies that just sit back and relax, rely on what's working now, they're not going to grow that much in the long run. It's a company that's going to be a real winner. They need a management team that's hungry, constantly investing in research and development, new products, better processes, got to stay ahead of the curve.
Yeah.
And he warned against stopping research just to make a quick buck. Dow Chemical, that was his example of a company that did it right, strong research and a great sales team.
Makes sense. So point number 6 is about proprietary advantages. What did he mean by that? What makes a company truly stand out?
Proprietary advantages. Those are the things that give a company a real edge over everyone else. And it has to last. Could be they're the cheapest producer, or they have an amazing sales network, or maybe they've got key patents to protect their inventions. But Fisher, he was smart about this. He said, don't just look at profit margins. Sometimes profits go up because everyone in the industry raised prices. That doesn't mean the company's doing something special. He used the copper industry in '56 as an example. Prices went up, but it didn't last.
Point number 7 talks about how a company treats its employees. How'd he link that to their investment potential?
He was big on treating employees right. Good labor relations, he said. It means happier workers, higher productivity, less turnover. All that adds up to a more profitable, efficient company. Companies that deal with complaints fairly and pay decent wages, they're going to have better relationships with their employees. And he wasn't a fan of companies that paid low wages and had bad working conditions. Thought that would come back to bite them in the long run.
He also emphasized being smart with money, right? What were the key financial things investors should look for?
He wanted to know if a company had enough cash on hand and if they could borrow easily so they could jump on good opportunities without being held back.
Yeah.
His logic was, if you're right about a company's growth potential, any future stock offerings they do, they'll be at a higher price. So short-term financing worries shouldn't scare you off from a great business.
He makes an interesting distinction between growth stocks and bargain stocks. What was his thinking there?
So a typical bargain stock, maybe it's undervalued by, say, 50%, but a really successful growth stock, that could go up hundreds of percent in a decade. And over time, that long-term growth, it really adds up. He was saying, find those exceptional companies, the one that'll keep growing, and you'll build real wealth.
He's pretty upfront about the work involved in his approach, isn't he?
Oh, yeah. No sugarcoating. He's very clear. Finding those golden opportunities, it takes serious time and effort. You got to Talk to people, do your scuttlebutt research. It's not something you can do passively. You got to be active, dig deep.
What about dividends? How important were they to him, especially for investors who are like in it for the long haul?
If your goal is long-term growth, Fisher felt that chasing dividends could actually hurt you. You might miss out on companies with way more potential but smaller dividends. He said, use only your extra money, the money you don't need for emergencies or planned expenses, for investing in stocks. Don't get too hung up on those immediate payouts.
And he was pretty skeptical of economic forecasts, right? Why was that?
He just didn't trust them. He knew that even the so-called experts often disagree, and they're wrong a lot. He was like, focus on the individual companies, their strengths, their long-term outlook. Don't try to time the market based on some prediction that might be totally off.
He talks about pilot plants, too. He saw investing after a successful pilot plant as a good opportunity. What was his reasoning there?
He figured if a company's pilot plant is working, it means their tech, their process, it's been proven, at least on a small scale. So when they ramp up production, expand, things are more likely to go smoothly, less risk.
All right, let's get to the buy and sell decisions. According to Fisher, when should a long-term investor buy a stock?
If you've got a good portfolio built on solid research and a long-term view, Fisher said, buy when you find a company that fits your criteria. Don't worry too much about those short-term market swings. Don't try to time the market unless there's a crazy bubble happening. He did say, though, new investors or people switching to a growth-focused strategy maybe be a bit more careful after the market's been going up for a while.
And when's the right time to sell? He had a few key scenarios, right?
The first one is if a company's growth potential is tapped out, even if the management's still good. If they don't meet those 15 earnings anymore, no real growth left, it might be time to move on. Find a company with a brighter future, even if it means paying some capital gains taxes.
What about when people say a stock's just gotten too expensive? You know, the price-earnings ratio seems high.
Fisher was against knee-jerk selling just because the PE looks high. He said, sometimes a high PE is fine, especially if a company's earnings are growing fast and they've got a long way to go. Focus on the long term, not just the current valuation. He had this analogy about, like, investing in your classmates' future earnings. Some might have higher prices because they're going to make a lot more later on. Same with companies.
He talks about retained earnings too, right? Like what happens when a company keeps its profits instead of paying them out as dividends?
He believed that when a company reinvests its earnings wisely, instead of giving it all away as dividends, it creates more value for the stockholders in the long run. Those retained earnings, they fuel growth, innovation, make the company stronger. And he pointed out that accounting, the way it's usually done, it doesn't always show the true value those retained earnings are creating, especially when there's inflation.
What about dividend policy? How should a company decide what to do with its profits?
He thought smart companies should have a clear dividend policy based on how much they need to keep for growth. Stick to it and be transparent with the shareholders. Let them know the plan. Increases in dividends should only happen if there's plenty of money for growth and the higher payout can be maintained.
He also had those 5 don'ts for investors. What were some of the traps he wanted people to avoid?
The first one was don't invest in promotional companies. Those are the risky ones. No real track record, not like established businesses. Let the pros handle those. And the second one was don't assume a high stock price means all future growth is already priced in. Really great companies, they often have high PEs for a long time because their earnings just keep going up.
And the other 3 don'ts, what were they?
Don't ignore the basics. Make sure the company is well run, has good cost controls, good accounting, efficient operations, and don't miss it when a stock changes. You know, a growth stock can turn into a non-growth stock if the market gets saturated or their edge disappears. And lastly, don't follow the crowd blindly. Be careful of those hot investment trends. Think for yourself. Market's often slow to catch on to real changes unless there's some big event or a famous CEO making headlines. Independent thinking, he believed, that's how you beat the market.
Let's talk diversification. How much was enough for Fisher?
He said it depends on the types of stocks you own. Some companies are already diversified, like big chemical companies with lots of products. They naturally lower your risk. But if you're focused on those high-growth A-type companies, he suggested a more concentrated approach. No more than 20% of your money in those, spread across maybe 5 companies, and make sure they're not all doing the same thing, competing in the same markets. Then there's the B-type companies, kind of in between high growth and the big established ones. They usually have revenues of 15 to 100 million, strong management. For those, he recommended spreading out a bit more, maybe 8–10% of your money, in about 10 different stocks, so you balance risk and reward. He gave examples like PR Mallory, which is now Duracell, Beryllium Corporation, Foot Minerals, Frieden Calculating Machine, Sprig Electric, all B types. He considered those safer than the really risky C-type growth stocks, and you could hold on to them even if the price went up a lot.
He also mentioned world events like wars and their effect on the stock market, right?
Yeah, he called them war scares. He saw this pattern when a big war breaks out or America gets involved, the market usually tanks. Except for World War II, that was different. But after the fighting's done, stocks tend to bounce back, go even higher than before the war. He figured the initial drop is because of fear, uncertainty, and the recovery happens because, well, money becomes less appealing when things are looking up, so people buy assets, stocks included. But he did warn that the real value of stocks during wartime might actually be lower because of things like taxes and companies shifting to less profitable defense work.
He addressed the efficient market idea, too. What was his take on that?
He wasn't buying it. The efficient market hypothesis, it says that stock prices always reflect all the public information, so you can't really find bargains unless you have insider info. But Fisher pointed out that different stocks perform so differently in the long run, which means the market can't be perfectly efficient. There are opportunities for smart investors to find undervalued stocks.
He also emphasized focusing your research, not trying to cover too much. What was his advice on that?
He said it's better to really understand a few companies deeply than to have, surface-level opinions on a ton of them. If you can't find enough information to feel confident about a company, move on. Find one where you can do your homework properly.
Okay, so you've done your research, you're interested. When's the best time to actually talk to a company's management?
Do your scuttlebutt research first. Talk to those outside sources before you reach out to management. That way, you'll have a good understanding of the business, the competition, the company's reputation. Good management teams, they'll be honest about their strengths and weaknesses, but they won't volunteer the bad stuff unless you ask. So do your homework, show them you're serious and knowledgeable, and they'll be more willing to give you the good stuff.
He was pretty confident that his approach could lead to big rewards, wasn't he?
Oh, yeah. He said, if you can find those truly exceptional growth stocks, the potential payoff is huge. He gave examples $10,000 turning into $40,000 or even $150,000 in 10 years. But he stressed that you got to put in the work, no shortcuts, casual effort won't cut it.
He also had his own definition of what conservative investing means, right?
She said, to be a true conservative investor, you need two things. First, you got to really understand what makes an investment conservative, like the underlying qualities. And second, you got to do your due diligence. Really investigate to see if a specific investment actually has those qualities. He thought both were essential. Otherwise, just buying stocks, any stocks, isn't truly conservative.
He focused a lot on manufacturing, but he said his principles apply to other industries too, right?
Definitely. He used lots of manufacturing examples, but he was clear that his ideas worked for services too. Wholesaling, retailing, finance, all that. You just got to tweak the language a bit. Production in manufacturing becomes operations in the service business. A low-cost producer becomes a low-cost operator. But the core principles, like finding great management, sustainable advantages, and long-term growth potential, they apply across the board.
He was big on marketing too, wasn't he? What was his take on that?
He thought a strong marketing department was essential. A good marketer knows what customers want, and they make sure the company's selling what's hot now, not what worked in the past. He considered that just as crucial as efficient production and fancy tech.
What about keeping good employees? Did he talk about that?
He said the best companies, the ones worth investing in, they usually promote from within. They build up their own unique way of doing things, their own culture, and it's hard to train outsiders to fit in, especially in top roles. Lots of turnover that way. He liked those companies that had internal development programs, like a Motorola's Executive Institute. That's how you find and develop talent, build a lasting advantage.
He touched on treating employees well, too. Why did he think that was important?
He believed creating a positive work environment where people feel valued, that makes a difference. It leads to higher productivity, lower costs, because people aren't quitting or calling in sick all the time. It's not just about being nice, it's good business.
And lastly, he talked about disciplined growth, right? What does that look like?
Real growth companies, he said, they reinvest a big chunk of their earnings back into the business. They're thinking long-term, investing in new products, better processes, training their people. not just trying to squeeze out every last penny of profit today.
He also talked about how some companies manage to keep their profit margins high for a long time. What were some of the common factors?
He said it often comes down to a few things. Economies of scale, meaning they can produce things cheaply because they're doing it on a large scale. Technological advantages, something that gives them an edge that's hard to copy. And a strong brand, loyal customers, making it tough for competitors to steal market share. But he warned against, blindly comparing PE ratios between companies. Future growth potential can justify a higher PE today. And he said, watch out for those industry-wide shifts in perception. He talked about chemical stocks in the 60s versus the 70s, franchising in 69 versus 72. Computer peripherals perceptions can change fast, and that affects stock prices even if fundamentals are still good.
He tells that story about Motorola selling its TV business, right? That's a good example of his principles in action.
Yeah, Motorola was struggling with its TV division, losing money. When they finally sold it, their stock price jumped. Investors liked that they were focusing on their stronger businesses, especially communications. Some analysts even thought that before the sale, the communications division was already undervalued compared to other big electronics companies like HP and PerkinElmer. It shows you how understanding the different parts of a company can give you an edge as an investor.
Finally, let's talk about Fisher's personal journey. What were some of the big lessons he learned along the way?
Well, he got interested in stocks back in the 20s, but his dad wasn't a fan, thought it was too risky, like gambling. But he learned about selling and marketing from a professor named Emmett. They talked business on road trips. His business school class was small, close-knit, great for learning. Then he got a job at a brokerage firm right after Hoover made that famous prosperity around the corner speech. Fisher was actually more pessimistic, but he smartly negotiated a contract that guaranteed his job based on performance, not seniority. One of his early wins was with Food Machinery Corporation in the 30s. He did his research, saw their potential, and that success really solidified his long-term approach. He figured out that quick trades, in and out, didn't make much money, and they were riskier. Long-term holding was the way to go. He also realized you got to act when you've got a good idea. He predicted the 29 crash but didn't fully capitalize on it because he hesitated. Learn from that. Another lesson, don't get too obsessed with small price movements. Miss the big picture that way. His investment in Dow Chemical, that was based on their commitment to efficiency, research, and treating their people right. Those were his core values. He also realized that even innovative companies stumble sometimes, and those setbacks can be buying opportunities if the fundamentals are still solid. But he also learned the hard way about due diligence. He invested in a pharmaceutical stock based on hype and lost money. And then there's the Texas Instruments story. Shows how tough it can be to manage client expectations. They wanted him to sell, but he saw the long-term potential.
Wow, lots of valuable lessons there. So, as we wrap up this deep dive into Philip Fisher's world, what are the key takeaways for you, the learner? What should you walk away with?
After all this, you should have a good grasp of Fisher's investing philosophy. It's about scuttlebutt, doing that deep research, and finding companies with sustainable advantages and huge growth potential, guided by his 15 points. And remember, it's a long game. Don't get distracted by the short-term noise. Think for yourself.
And this is just the beginning, right? There's always more to learn.
Absolutely. Go read Fisher's book. See how his ideas fit into your own investing style. Start thinking about companies out there today. Which ones have that strong market potential, that commitment to innovation, a solid management team? Who's doing things right?
Great advice. And here's a final thought for you to chew on. Fisher believed in long-term growth, not short-term trading. So think about this as understanding a company's long-term vision, the management's plan for the future, more important than trying to guess what their earnings will be next quarter. Something to ponder. Thanks for joining us for this deep dive.